In this week's update, a short-term risk to markets, what is really going on in China, and gold sets a new high. My name's Garry Davis. As always, this is general advice only, and please remember to like and subscribe to the video. Our market perspective to start with, I just thought I'd put a bit of a focus on China at the moment because there was some data out. There's been a lot of very negative commentary around China for probably 12 to 18 months about the problems with retail spending, the problems with the construction sector, etc. But some recent data out really shows that, if you can rely on the data, of course, that 2024 has started considerably better than what the commentary would indicate. Retail sales were up 5.2% across January and February. That's based year on year. Now, it could be the start of 2023 was abnormally weak. We'll have to say it, we'll have to see, but at least it's significantly better than it was at the same time last year. Holiday spending and travel are at record levels. There is robust industrial activity. So there's no question that China is not performing as badly as a lot of the commentary would indicate. And of course, that has implications for commodity prices and just also for global economic expansion. But as I've said a couple of times in recent months, the future growth of China, if you're just looking at the headline GDP numbers, then it's not really going to tell you specifically how it's going to impact us, because the future growth of China is almost certainly going to be of a different character to what it was in previous decades. And it's still a little unclear what that will mean for the Australian stock market. Meanwhile, the US rally just keeps rolling on. The Fed has said that they expect 3 rate cuts this year. That's what the dot plot diagrams are saying. They seem to be surprisingly relaxed about the inflation data, which came in a little bit hotter than expected. Not excessively, but a little bit more than expected. So it's not continuing to fall away as many thought. But look, this was good enough for the market, and the rally has continued on very strongly. So that's all you really need to know. And one of the key things when we've got conditions that are as conducive to markets rallying, so inflation peaked, rates peaked, economic growth strong enough, unemployment low enough, these are really good conditions. And in that sort of situation, then momentum just continues to roll on. And if you're not a part of it, then you're missing out big time. So the S&P ended up 2.3% for the week, despite a bit of a pullback on Friday. And the aggressive sector leaders continue, so they're not dropping off the perch, but more and more are joining in. If you look at it on an industry group basis, so there's 200 plus industry groups, there are many, many industry groups that are joining in and trending very strongly. So it's as complete a set of indicators that you're just about ever going to see in the US at the moment. And valuations really aren't that excessive because in many cases, earnings are growing so strongly. Now, just one little flag, and this is very short term. So this, in fact, I wrote this earlier in the week, expecting that it would come into play because the last 10 days or so of each quarter, there is a blackout on corporate buybacks. And corporate buybacks are actually a big thing in America for those that don't know. In Australia, companies pay out dividends, whereas in America, rather than paying out dividends, they tend to buy back shares, which has the effect of raising earnings per share and hence the share price. And it is a significant contributor to market liquidity and to higher prices. And we are now in a blackout period in America. Yet despite that, the market just keeps rolling on. So there's just, another indicator of just how strong the underlying buying is. So whether that will kick in the remaining days to the end of the quarter, we'll have to see. But look, if it does, it doesn't change anything much, really. You might just be able to use that bit of information to assist you with perhaps with some entries. But at the moment, there's really no sign of it having much impact. The US dollar index was a little bit higher again, pushed up to 104.5. The 10-year yield went lower again, got up to about 4.35, back down to 4.2, and the VIX continues to trade in the low teens. So, things are looking pretty good in America. Let's go and look at some charts. I'll start today with the RSP, which is the equal weight S&P 500. So that's taking out the effect of the really huge companies, the $1 trillion market cap companies, and just treating every company as an equal contributor to the S&P. And you can see it's had a very strong run since the bottom of the market in late October last year, and we're setting new highs now. It has lagged because obviously the parts of the market that took off first were a lot of those very big tech stocks. But there's more and more of the US market is joining in, and that certainly reflects. If we look at the S&P, it's still sprinting. It's going up at a very, very strong uptrend, as you can see. And this is a weekly chart. So there's been almost no pause at all. We had 1 week here, 1 week here, but that closed well off its lows. 1 week here, down very, very slightly, closed off its lows. So this has been an extraordinary move. So that's the S&P. There's absolutely nothing has changed there. Now, of course, as markets go up like this, a lot of people start to fret that they've gone too far too fast. But one of the things that you've really got to understand about markets, and particularly the US market, where trends do tend to be truer, if I can use that term, they just seem to, once they break out, the breakouts tend to be supported in these kind of environments, and they will tend to roll a lot further than what anybody really thinks. So let's jump in and look at some of the relationships and the market flows within the market. This is the Nasdaq versus the S&P. Had just a little pause over recent weeks, but started to turn up again. So the more aggressive sectors are basically still seeing their share of the money flows. Semiconductors. This is on a weekly chart. I highlighted this back in September last year as being a very key market indicator. And we had at the time, a very bullish flag formation here because we'd run up strongly from the lows in October 22, hadn't really pulled back very much. It just consolidated a high in a flag and then absolutely took off when we got to the end of October last year. It's really just gone straight up. This orange line here is the 8-week moving average. So it's been an extraordinarily strong move. And I'll just highlight, a couple of weeks ago, you may recall that there was a bit of a fright on the Friday the 8th of March, big reversal candle, high volumes, and a lot of people got incredibly anxious about what that meant. But at the time I said, look, just we need more indication than this. Just relax for a few days and see how this plays out. And as you can see, we were down the following day, and there was a little bit of follow through to the downside. But this is nothing more than just a normal pause. In fact, a healthy pause. And we came back to the 20-day moving average, which is the key points where the market has found support, and then turned around and bounced straight off that. So the message there is, don't go reacting, particularly with an index like this. If this was an individual stock, then there might be a justification for managing it on the merits of that particular situation. But when it's a huge index here, you've really got to see what the follow through is. And there was very, very little follow through. In fact, the bit that we got was actually quite healthy. So that's the semiconductor ETF. And if we look at that relative to the S&P, just a small blip, small underperformance for a week or so, and then heading straight back up again. Let's look at the sectors over the last quarter. Communication services still leading the way, and of course, the first observation is that they're all in uptrend. And then the outperformers, communication services, finance has done really well. The banks have done particularly well. Technology, energy has certainly recovered. Healthcare, and then we get down to materials and consumer staples, and then discretionary at the bottom of that particular order. But on an industry group basis, as I said earlier, there are just so many more sectors joining in now in uptrends. And if we look at that over the last, let's say the last fortnight, energy has certainly done really well. So that's been the star of the last couple of weeks, and communication services has continued to be pretty strong. All right, let's look at Australia now. While I'm here doing these sector relationships, and over the last quarter, information technology has been the very clear leader in Australia. Finance, the banks have done well, but I've got some more to say about that in a minute. Small caps have also done okay in Australia, and then we've got healthcare, energy, and materials sort of bringing up the rear. In fact, materials are really down over the last quarter. If we just want to have a look at what's happened in the last couple of weeks, you can see pullbacks on Friday as these indices sort of saw a bit of profit taking, but it's still pretty much the same order, although materials has been a bit stronger in the last couple of weeks. Just a couple of other charts that I want to show. One is this is large cap growth versus large cap value, and it's still, whilst there are a lot of value stocks now starting to join in, as far as the large caps go, it's still winning that race very, very clearly. So that's the US market. If we look at the US dollar, you can see we're perhaps now starting to form higher highs and higher lows, and breaking out above this top of the range. So we may be going back into a bit of an uptrend in the US dollar, and of course that has just spiked the Australian dollar down. So that was the state of play in the US market. 64.5 is where we finished. Our market added 1.3% across the week. We are in the most robust few months of the year. You may have heard the term sell in May and go away. And we've had such a strong run in the Australian market that we may see a bit of a pause. We may even see a bit of a pullback, but not so much because it's sell in May, but more about the fact that particularly the banks are at risk of some selling. They're sitting at the top of their historical PE bands. And there's nothing wrong with that. We are in a very bullish market, so why not? But they're sitting at the top of those historical bands. And in the case of CBA, their PE at the moment for FY24 is sitting at around 21. 21 times is very high for any banks, and even for the CBA. But it's happening at a time when earnings appear to have peaked, because the earnings forecasts for FY24 and FY25 are for earnings to be reduced. And a lot of analysts cover the Australian banks, and the drop off in earnings is pretty clear. So that's not a good combination. Historically high PEs and earnings that are peaking. So don't be surprised if you see the banks go into a bit of a cycle of sideways to down. And that, of course, will impact on the ASX 200. And we've also got the major miners that are stuck because commodity prices are uncertain. Iron ore hung up there above 130 for much longer than seemed reasonable. Then it dropped to close to 100. But now it's starting to work its way back up again. And maybe the data out of China is not as bad as it's being portrayed. So there is just a lot of uncertainty around commodity prices. So I'm not sure that the major miners can contribute a great deal to the ASX 200 either. So I'm not expecting great things there. But the good news is there are plenty of terrific Aussie growth stocks, really high class, highly probable, high growth, well managed, often founder led businesses where you can do extremely well. So just go and do that and don't worry about the rest of the market. Let's just go and have a look at some of those Aussie stocks. So first of all, the ASX 200. This is on a weekly chart. So we had a breakout on the first week of March, followed through the following week. We got a down week in week 3, and this was an up week. But we may be coming to the end of that, and I wouldn't be surprised if we just sort of hang around this level, possibly even come back a couple of 100 points over the next little bit. But having said that, April historically not a bad month for markets either. There's the materials index on a weekly basis. Materials did advance last week, but they'd been down pretty consistently for a period of time, and you can see the volumes were up as well. Emerging companies index doing very well. So there's some good small caps in there contributing to that. Energy not really doing anything. The banks have had a terrific run since November, but as I said, their earnings would appear to have peaked. So I wouldn't be surprised if we see this as the all-time high, or the current all-time highs for the banks. Healthcare sort of stuck as well, just going sideways, but it's information technology where the momentum is in Australia, so that's looking particularly good. Let's go now to gold. This is gold in Australian dollars. So we finished at 3,324, and we did have a bit of a spike upwards as well. We'll see that more clearly on the US dollar price. So that's the Aussie dollar gold price. So that's really, really profitable territory for Australian gold miners. Here's another one of these spectacular intraday spikes on gold. Happened on Thursday. This is showing 2276. Now, some of the other data that you might see will not show a high as much as that. So it depends a bit on what the chart you're looking at is, what data it's actually using, whether it's using futures data or spot data. But look, it's not dissimilar to what we saw here on the 4th of December when it spiked up very significantly intraday, and then it took quite a few more days for that to settle down and for the price to pick back up again. So we may just see a bit more downside, perhaps a pullback to the 21-25 kind of area. But certainly gold, you've got to say now that gold it's broken out, it's hung onto it, it's in an uptrend, and gold stocks really should pick up. But the response so far is it's getting better, but it's not as good as you would expect. There's the gold price on a weekly basis. If we look at GDXJ, a little bit of a response. but not too much. But look, in Australia, there are some stocks where we're starting to see gaps higher. We're starting to see more positive closes. So maybe things will continue to improve in that sector. So just to recap, gold up $10 to 2166. When you look at the candles, leaving aside that big intraday spike on Thursday, when you look at the candles, it's clearly very demand-driven buying, where we're closing more on the highs than not. Spoken about that crazy spike, and 3324 in Australian dollars is the local gold price. So finally, we're seeing some gaps. We're seeing some large upward candles in Australian smaller mine developers, and we're also seeing them close on session highs. So there certainly are some very welcome positive signs in the gold market in Australia. Other commodities, copper, these just a fraction, back to $4. Nickel also slipped back down to 7.74, and crude oil is still hanging around the 80.5 mark. Just an update on uranium. Of course, these high prices are going to increase supply. There's been some commentary kicking in of late that the increase in supply is going to put a lid on prices and, in fact, push prices down. But the reality is that an increase in supply is just not going to be nearly enough to put the uranium market back into balance. And Cameco were out during the week saying that there is a structural shift in demand by utilities. The term contracting, in other words, the amount of uranium being sold under long-term fixed offtake agreements, went from 125 million pounds in 2022 to 160 million pounds in 2023. So they're long-term contracts. They're not demand figures that chop and change. They're set now for a lengthy period of time. And the other point that was made too is that prices have never been this high. So uranium prices have never been this high in the early part of a contracting cycle. So utilities, after what happened in 2011 in Japan, went into a very lengthy cycle where long-term contracts were really few and far between. This is the early part of a new contracting cycle, and it's starting from a point that's never been this high. So, these are all pretty strong indicators for uranium for the long term. There's the spot copper chart. So we got to about $4.14, I think, on copper, and pulled back to $4. And there's the crude oil chart as well. So wrapping things up, the US market just continues to move higher, to expand in breadth. There's more and more industry groups joining in. So this really is the sort of rally that you would expect, to be honest, in this kind of environment. It's been underway now for almost 5 months. And when you look at the fundamental economic data, when you look at the price charts, when you look at earnings, it's as complete a set of signals, of positive signals, as you're ever going to get. And that's why I've been saying that 2024 is set up as about as good as it gets. And if you're not participating fully, if you're concerned about markets peaking because they've run so hard, then I think this is a time when you can just get on board the momentum. You've still got to be sensible about entries, but the overwhelming odds are that well-selected, high-quality stocks are going to continue to move higher because this is just that sort of market environment where they can do so. Portfolio analyst last week was about building copper exposure. We had a look at some of my favoured copper stocks and also my favoured Australian technology stocks as well. So there's a $1 trial for 2 weeks for anyone that hasn't had a look at that. There's a huge amount of archive information, videos, lots of learning. So I think you would get a great deal out of spending a couple of weeks going through the portfolio analyst service. That's it from me for this week. There's more information on the website. There's my email address. I'll be back with you next week. Cheers.